time. Tonight, we're going to be asking these two experts in their field to help guide us and give us some general ideas of what we should be looking at in the current market conditions. In the last few weeks, the headlines every day have caused investors around the country and really around the world to be nervous about their investments in their portfolios and have generated many questions about what the wisest approach to the current market conditions may be. We're lucky to have Bob and Debbie here tonight to talk to us about that. And I'll ask first, Bob, if you could take the floor and tell us a little bit about the current market conditions, what's happened in recent weeks, and where we should go from here.
Thank you, Chuck. Can everyone hear me?
I have them on. They're not.
Can everybody wave? Good. Okay, terrific. Hi, everyone. Thank you, Chuck, and thanks to all of you for taking time during this historic crisis to join us. I was a history major in college, so I'm always interested in what is really going on behind the scenes. So let me take you back to the end of 2019 in order for me to set up what's happened since then. Remember, we began 2020 on a positive note. Markets had rebounded nicely in 2019, both stocks and bonds, and interest rates were starting to trend lower, as was the price of gas. Late in the year, the Phase 1 trade agreement with China gave a green light to reticent investors to go back into the market and load up on stocks, often using borrowed money to invest in the market. On February 19th, a little over 6 weeks ago, the Dow and the S&P 500 hit record highs, the Dow at 29,568 and the S&P at 3,393. We knew even then about the coronavirus and its effect on China, but it was still a distant issue and something that was unique just to China. A crisis caused by a global pandemic was unknown to all of us. The last global pandemic was over 100 years ago, so none of us knew what to expect. As the risk of the pandemic grew, a secondary crisis appeared. An oil supply war broke out between Saudi Arabia and Russia, dropping the price of oil from $50 a barrel to today it stands just above $20 a barrel. The growing crisis became multidimensional. As the virus spread to other parts of Asia, Japan, and South Korea, and then Italy, it became clear that the virus was not contained to China and would spread globally. Normally, this would be enough to fuel frightened investors behind the scenes. But in the capital markets, something else was going on and happening, which caused more volatility and steeper drop in prices. The initial drop in the market was forcing heavily levered pools of money to sell, hedge funds, private pools, and investors on margin. First, stocks fell, but then every major asset class, stocks, bonds, municipals, real estate investment trusts, even money market funds came under extreme selling pressure and saw limited buyers. The market infrastructure couldn't keep up with it, and the drops and the bounces became bigger. Alongside all this, individual investors started to see businesses in their community shut down. Your favorite barber, hairdresser, Uber driver, and even your son-in-law, the dentist, had to shut down his practice. The selling by both professionals and individual investors accelerated, and the search for liquidity spread from stocks to bonds to all other asset classes. A little over 1 week ago, stocks were down 33%, and even the safest asset class, municipal bonds, were down 8 to 10%. Fortunately, with speed and then force, the Fed stepped into the breach with almost $750 billion of immediate support to the fixed income markets. They literally bought everything in sight, from treasuries to money markets to municipal bonds and corporates. In less than a week, the highest quality fixed income markets have almost returned to normal. liquidity and two-way flow has returned to the fixed income markets, and stocks have reversed their decline. In turn, the Congress and the President have passed the largest economic stimulus package in history, over $2 trillion that's designed to sustain workers' incomes and keep businesses alive. The critical support of our economy needs to weather the crisis without doing any unalterable damage to our infrastructure. It's truly remarkable how fast all this has happened, pretty much in a matter of 6 weeks since the high in the market. There remains a lot of uncertainty yet ahead. So I know many of you want to know, where do we go from here and what can we do? So I'm going to turn the hard part over to my colleague, Deb Baker, to talk about, what things you can do with your own investment plan, your planning with your assets, and some ideas of how to weather this storm and get to the other side. Deb?
Deb needs to unmute before she can be heard. There you go.
My apologies. I thought Deb was in control of that. So can everybody hear me now?
Yes.
Wonderful. Okay. Well, Bob, thank you very much for sharing that perspective. I'd like to spend a few minutes tonight sharing what we can learn and apply from previous corrections, the importance of having a plan in times like this, and what should we be doing now as investors. So first, what can we gain from market history? Mark Twain famously said, history does not repeat itself, but it often rhymes. And as Bob said, in the past few weeks, we've experienced the fastest decline in market history, with markets falling 34% last Monday, but then in only 3 days, turned around and rallied back over 20%, one of the fastest reversals ever. It has been a roller coaster of events, which are absolutely unprecedented, but we do know we've been here before. I started in the business back in 1986, just in time to see Black Market Monday, the frightening period that was September 11th, and the Great Recession of 2008, 3 of the worst bear markets we've ever seen. All of them brought us down 30% in stock market value, and all of them actually began for different reasons. The one thing we do know is that we eventually did make it through. The market value went on to the old highs and moved on to new highs, and I have no doubt that this time will play out the same. For those of you who might not know, a bear market is defined when the stock market falls 20% or more, and it typically goes through 3 phases. You first have what we've experienced recently, the waterfall event, shock and awe, tremendous uncertainty, and massive selling and declines of stocks and bonds, as Bob said. Then we enter the sideways phase, can be known as a whiplash phase. On the news that's coming out, some days were high, some days were low. Eventually, the market finds a bottom. We typically do what's called retest the low values that we have hit, and then the market starts to repair and build from there. So this might most likely will not stop until we get the cases of coronavirus to eventually level off and start to drop. But we do believe with the government assistance, which is going to help us bridge the economy, the lower rates that we have now will eventually help our economy come back. So in these periods, I like to reiterate to our investors the importance of, number one, having that plan in place and sticking to your plan. On having a plan, hopefully wherever you are right now in your life, you have some form of a financial plan or goal. If you do not, it's a very good time to take a look at your situation and your goals and take the steps to form a plan. I know we as Rotarians on this call are at various different ages, but there are some basics that apply to us all. With any client, at whatever age, I always stress your first goal financially is to have an emergency reserve of savings. Typical guidelines would tell us a minimum of 3 months is good to have, exactly to prepare for times like we're going through right now, a job loss, a health event, whatever it might be. After that, we should all be building on our savings by investing. A guideline to maintaining our lifestyle in retirement says we should be saving at about 10 to 15% at all times of our annual income. In times like this, no, I realize we have fear with investing in stocks, but stocks truly over time have the best returns that offer us the opportunity to build wealth. Since the Great Depression, stocks have compounded at about 10% per year. Bonds, so if you think about like CDs or tax-free municipal bonds, typically compound around 4 to 5. And if you balance those two together over your lifetime, you should be able to achieve a 6 to 7% rate of return. And there's a valuable rule in our industry called the rule of 72. This tells us how fast your return will double your money. So if I'm all in stocks at 10%, 10% goes into 72 about 7.2 times. I'd be doubling my money about every 7 years. A 4% bond, which we wish we had now, would double in about 18 years. And a balanced portfolio should double in about that 10-year time frame. Hopefully you have some of these investments as part of your plan. The 10-year treasury right now that is literally about 0.8% would take 90 years to double your money, which is just incredible to even think about. So we know saving and having that well-balanced plan for your strategy will help anyone at any income level build wealth over time. So number 2, the hard part, sticking to your plan times like now. This is very hard to do. There's another saying out there that stocks actually do deliver 10% return over time, but only if you stay with them the whole time. We cannot get in and get out. We have to stay the course in good times and bad and think like Warren Buffett. I like to tell my clients it's going to be 2 steps forward, 1 step back for most of our lives as an investor. Feels like you've just gotten ahead a little bit, and we have these retreats that come along like now. But again, keep in mind, market corrections are actually part of the investing cycle. They occur on a very regular basis. Since post-World War II period in 1945, we have on average about a 10% correction every single year. They happen so quick, it usually takes about 3 months to come back from. A 10 to 20% correction, we get on average about every 5 years. This takes the market on average about 7 months to come back from. The last one we had, you might remember, was at the end of 2018. 20%, 30% plus corrections are even more rare. We've had 10 of them since 1945. They come on average about every 7 years. The last one we had was 11 years ago in the Great Financial Recession of 2008 and 9. These more severe corrections can take us sometimes 18 to 24 months to get back up to the top. But keep in mind the positive side. Since 1980, 40 years, 30 of those years have been positive for the stock market. 10 of them have been negative. So this is why we end up building wealth over time, staying with our equity exposure. So again, it's not a wise time, to panic or sell. This can be a detrimental mistake to our financial plans. Since 1998, the market has actually returned about 7 1/3% compounded. Now keep in mind that contained 2 of the worst corrections our market's ever seen around September 11th and the recession of 2008, where stocks lost over 50%. But you still compounded it at 7 1/3. If you missed the 10 best days, I panicked a little bit and I decided to get out and sit for a bit. If you missed the 10 best days in that period of time, your return was reduced to 3.48%. If you missed the 20 top days because you wanted to sit on the sideline, your return was reduced to 1.49%. So again, we just want to take a deep breath in times like this and try to stay the course. So with that history perspective, a few ideas on what we can do now. The most important thing we can do as investors is rebalance and to take advantage of when markets go higher and markets go lower. If by chance you looked at what Bob shared last year, markets were up over 30% here in the US last year. Well, if I'm a person who has maybe what I'd call a 60-40 portfolio, maybe my retirement plan, my savings, I've got 60% in stocks for growth, I've got 40% in bonds for defense and income. Well, last year with that big run up, your 60-40 portfolio might have transitioned to a 70-30 portfolio because the stocks went up so high. That's an opportune time to say, take a look at that, sell the stocks at their highs, rotate to the other column, get yourself back in balance. And right now with the situation we're facing today, that 60-40 portfolio is probably looking more like a 50-50 portfolio because the stock portion has dropped off so much. Now's a perfect time to revisit that strategy, take some out of that bond column and rotate back to stocks, and you're buying prices right now much lower than they were just 5 weeks ago. Number 2 would be investing. The old adage in our industry is to try to buy low and sell high. Most people are not good at it. Right now is the time you want to sell. As a matter of fact, they said 2 weeks ago when we hit the bottom of the market, they showed that we had record sales of individual investors like you and I. They called Morgan Stanley, they called AB, they called Charles Schwab, they called Vanguard and said, get me out. It blew away all the records that we had from 2008. And those investors, if they sat there, missed the 20% run up last week. So that's never a good idea. I'd like to share with you just a few comments stating from my firm, talking about when you go through a severe bear market like this, you usually don't see an event like this without changing what we call the leadership in the market in the next cycle. The stocks that did well in this past 5 to 10 year run of our markets will probably take us backseat to a new group of leaders. Growth stocks have absolutely dominated the market for the past 10 years. We are starting to think that the value side of the market, more the dividend payers, which have really underperformed in the cycle, could be the next stocks that lead us into the new recovery. So keep in mind, those could be great opportunities. International stocks are historically cheap to where United States stocks are priced right now. Small and medium-sized companies through mutual funds usually lead us out of recessions with some of the strongest returns. And if you're looking at individual stocks that offer high quality balance sheets, dividend payers could be good selections to be getting in at this time. And the industry is believing that technology, healthcare, and financial services companies could continue to have a good pattern from here. So it's very easy to invest in these types of categories through mutual funds, exchange traded funds. Again, I would stress here that it's beneficial for you to get some professional advice. And on the last note, if you have some money on the sideline out of your needed savings account, the next few weeks could provide some good opportunities for the long term. If you do not have cash on the sideline, I encourage people, try to up your 401k contributions during times like this, where you're adding at lower prices. Maybe make that IRA or Roth contribution you might be putting off till the end of the year to take advantage of a market that is still down right now over 20%. And then a final quote I'll leave you with is that, oddly enough, the market is the only thing that people run away from when it goes on sale. So keep calm, try to think like Warren Buffett, and just keep saving and investing. So I hope this has been helpful, and I'll turn it back to Chuck.
Thanks, Deb, and Bob, for both of you for your comments. I've got a couple questions, and then folks, if you're on the call and you have a question, if you can put it in the chat or raise your hand, I'll try to mix your questions in as well. Bob, how much will the shutdown that we're going through right now, and looks like it's going to continue probably through the end of May, how's that going to impact the economy and investments?
Yeah, everybody's asking that question, and there isn't a certain answer because there are so many uncertainties right now, Chuck, about how long it will take us to extinguish and to ring fence the virus, and will there be any kind of outbreak later on in the year. The way we're looking at it right now, from an economic point of view, is if the shutdown lasts through May, so let's say it's a 2-month shutdown, the economy is going to slow. You're going to see unemployment balloon up. You'll see GDP drop precipitously, but only in the second quarter. So our projections right now are that the GDP of the US will drop about 20%, but then it'll recover. And in fact, that recovery, as long as we're able to contain the virus and keep the economic damage limited to the period that the stimulus should cover, which is the next 2 to 2.5 months, then we should get a bounce as pent-up demand as kids go back to school, as people go back to work. So while the period immediately ahead, as Deb mentioned, really is all about stopping the curve of growth in the virus, beyond that, once we do that, the pent-up demand that comes back into the economy in the second half should give us a robust second half and leave us about flat to maybe down 1 or 2% on the year. So I think there's a silver lining to all this, but there's some things that are uncertain ahead of us yet.
With the news that came out over the weekend and the forecasts of, so many people in this country and worldwide likely to be, getting the virus, has the market already taken that news into consideration so that it's bottomed out now, or is there more bad news to come?
As Deb mentioned, it's really hard to pick bottoms of the market. If you look back at all the bear markets, there were few people that wanted to buy at the bottom. So that may still be ahead of us. It may be behind us. It's really tough to tell. I would say that averaging into the market at this point makes sense. So if you have excess savings to invest, as Deb said, this is a very good time to do it. You're getting really good discounts on prices. That leads to higher expected returns. But I think there's some uncertainty left ahead. So you don't have to be in a hurry to invest at this point.
Yeah, could you explain what you mean by averaging in?
Yeah, averaging in is whatever pool of money you have to invest, instead of picking one day or one point in time to invest, break it up into pieces and put it in slowly and methodically. Especially in down markets, this is a strategy that works especially well because we don't know, what the low price is. So if you invest some today and the market, gets more bad news in a couple weeks and falls, you've got an opportunity to buy again and average down. So it's a process of averaging down. Averaging up doesn't work as well. Averaging down works real well.
Now, Debbie, you had mentioned about rebalancing investments now. Is this a good opportunity? Maybe you could address bonds in the investment portfolio now. What is your view? Is this a good time to invest in bonds?
Absolutely. Yeah, great question. Rebalancing, as I alluded to, is very important because, again, when you see these severe swings, we had a big up run last year. We had a big pullback now in the past few weeks. So, it's easier nowadays to view things through, an online site or talking to your advisor just to find out where that allocation is sitting today. And again, consider rebalancing to, get yourself back in line with where you're comfortable and you're sleeping at night. Bonds today are definitely a challenge. We are investing right now. Interest rates have hit all-time lows in the past few weeks. Our treasury bonds have never, ever been lower. And bonds, when you're buying, when yields are low, eventually when yields rise, the price of a bond will come down. So it's possible when rates are rising that you can lose money in bonds. In a time like this, I really can't stress enough it's how important it is to maybe use a professional manager, using a mutual fund and working with an advisor to give you some advice on what particular area to be in. There's bond funds that will go into treasury bonds or mortgage bonds or what we call like a strategic portfolio. You're trusting the manager to be in the right sectors at the right time. One area of bonds that will start doing well at some point will be what we call like an inflation or floating rate bond fund. This type of an account will go up and roll rates as rates are climbing higher. I don't know if we're at the point to get invested there yet, but again, this is something, and now days like now where we have the lowest interest rates we've ever seen, it's really critical to get some advice.
I'll throw this to both of you. There's been a couple of companies we've seen in the news the last couple of days who are redoing their assembly lines, going from making cars or other manufactured goods over to the medical devices, the ventilators, masks, you name it. Do your companies take a look at that nimbleness of a company and see that as a value that can be perhaps invested in?
Sure, I can comment on that. I will tell you right now, Zoom stock is skyrocketing over the past couple of months. And they say, in any crisis, there's winners and there are losers on either side. So obviously we've got a lot of industries, airlines, cruise lines are hurting right now incredibly. But you're seeing, companies like this Regeneron or Gilead Sciences, they're working on vaccines for the coronavirus. Their stocks are moving higher right now. So there's, definitely going to be a situation, sure, where a company is, is producing and using not a good opportunity, but is an opportunity to produce more. That'll be reflected in their earnings and, make that probably a good holding for the foreseeable future.
Any comment on that?
Yeah, I would say this is the real value of active investment management. If you're familiar with, there are a number of ways to invest in the market. One is to do it passively, which is just to invest in an index fund or an ETF. Those portfolios literally include everything that happens to be in that index. So they don't delineate between the winners and the losers. I think what Deb was getting at, which is really important, is there are stocks today that are in the S&P 500 that won't be there 2, 3, 4, or 5 years from now. But there are companies, if you choose individual companies and you use active investment research, that are easy to identify today as the companies that will come out of this crisis and thrive in the period ahead in whatever the new normal is. And you can just see by this meeting how things are likely to change, how the average day-to-day activities that people engage in and the way they engage in them are going to change. And it's going to create enormous opportunities for the companies that have solid balance sheets and have the wherewithal to get through this period ahead. They'll thrive afterwards.
We got a question from Debbie Massetti about contradictions in the marketplace. Here we have a rally last week, Thursday, when it was announced that unemployment claims were up over 3 billion. How do you explain that rally? Is it looking at other factors? Is it taking it into consideration? Comment on that from either of you.
Yeah, I'll comment on that, and Deb may have a comment too. You know, it was anticipated that number was going to be over 3 million. And oftentimes the market is ahead of the news. And this is a perfect example of that. The market already anticipated that with all the shutdowns, 3 million would be a good number. Believe it or not, that's the worst number we've ever seen. But the fact that it was better than expected, coupled with a number of other factors, for instance, the stimulus package, which, you know, it was in the process. The Senate had approved it. The House was looking at it. I think people were focused more on that issue than they were on an issue that they knew was probably, you know, already in the market and already in the economy. And that's one of the things that's hard to follow. If you follow news day to day, oftentimes that news has already been discounted and been decided upon, and people are off to the next headline.
Well, let's talk a little bit about folks who may be on that unemployment line. There was some rules issued say that you can draw on IRAs early without penalty. Some other relaxations of some of those rules. Either Debbie or Bob, you want to speak to that? When is it a good time that you dip into your retirement account early as opposed to letting it sit through the market correction?
If you'd like, I could take that one, Bob. Whenever we're looking at a client's needs, and maybe I am unemployed and I've got to get some emergency sources of income, we always like to say that the retirement account is normally the last place we're going to go. We are limited as to what we can put in our retirement plans over our lifetime. It's the one tax-deferred vehicle we have in place with us. So normally we're going to say, let's try to go to, you know, number one, possibly your emergency reserve of savings, you know, that we've talked about, knowing that I can fall back on that to get myself through for the next few months. Next would be other lines of saving. We encourage clients too, it's wise to have like a home equity line or a resource that you can fall back in the event of an emergency. You know, right now, if you have the emergency come up, it's the last time you really want to be selling your investments at any time because the prices are just so down severely. You know, sometimes you can fall back on having a home equity line to draw some equity and borrow, especially at today's low interest rates. So beyond, you know, the emergency savings pool, whatever you can draw from unemployment, sometimes we just buckle down and say, no, we have to do what we have to do. I've, you know, got to cover for my children. I've got to feed my family. So we will look at strategies then to go ahead and draw down on the retirement account with knowing that as soon as we're out of our situation, we get back on track immediately and try to maybe slowly replace the funds that we had to take away and, you know, get right back into that tax deferred savings. But that would be the last place we'd usually direct a client to go.
Thank you. How about anyone else from the audience? Any questions you'd like to pose to either Debbie or Bob? Debbie, Ross, I think you unmuted everyone.
I did, just so everyone could talk.
Okay. Well, why don't you go ahead and remute them because there's some background noise.
Oops, sorry about that. Oops, Chuck, I muted you, sorry.
Okay.
I'm a bad producer, sorry about that. Fire me.
No problem. It's not our day job. Well, I appreciate you guys coming on and sharing your information. Why don't we end up with a question about what signs should we look for that the economy is actually recovering so that we can look forward to some happier days.
Yeah, if I can take that and Deb can add to it. You know, we're fortunate. Our firm has teams of analysts on the ground in China, and they've been, you know, hunkered down since January, and they're all getting back to work. And so what we're seeing happen over there is we're seeing kids going back to school. We're seeing people going back to work. We're seeing, you know, the amount of energy that's produced for plants going up. We're seeing the highways start to fill up again. I mean, those are all the same things that we should look for here. So once activity starts to normalize, that's really the sign that the economy is going to start to regain its footing and get back to normal. And really what the stimulus plan is all about is just getting us through this period where we're all sequestered at home, you know, trying to extinguish this virus. But as long as we're successful at that, normal life will come back. And those are the best signs of all, Chuck.
Very great. Debbie, unmute yourself and you can have a final comment.
Yes, on following up to that point, I was just looking at some research we had that showed what played out in China. And it just happened to be when the China cases were peaking and rolling over, that was when their market was making its final bottom. And it's just been a turn and an acceleration since then. So our research is showing is that if we can get the cases in this country to peak and then start to know that we're having a declining amount of cases, we think that's going to give some relief to the market. However, you know, we know they say this is about a 4-week process. And the one thing we don't know right now is it peaking in New York now, but Florida is about to turn, or Chicago is about to turn worse. And that's what they're starting to wonder, is it going to hit those other cities? So even though maybe New York is peaking in 2 weeks, is it possible that, you know, we're not even there yet in Florida? So this will probably play out over April, but we would expect, just as Bob said earlier, you know, this is going to be the sharpest decline we've ever seen in our country's GDP. It's going to be the fastest, highest increase we've ever had in unemployment. But they're saying once we get over that hill of the peaks, probably in April, we should start to turn around, markets would bottom, and we will have what they're calling will be the sharpest snapback we've ever had to our markets and unemployment heading into the second half of the year. And the China is showing good progress. We've heard that 95% of the Starbucks stores are open. Nike said 80% of their stores are open. I know their GDP, some numbers came out today from China that were actually kind of encouraging. So there's hope. There is hope for sure down the road, and hopefully it'll be by summertime.
All right, well, all hoping that much as we like to be in our homes, we'd love to get outside and get back to normal. I do want to thank everybody, thank both Debbie and Bob for spending their time with us tonight. And if everybody on the call can give them a wave of appreciation, there you go.
Thank you.
I think it was well